Hey everyone. Today I'm going to be going over what to do when a stock that you have an option in or a stock that you have invested in starts to go down and you're in trouble. There are several ways you can fix this. In fact, there's about 60% of the time you can still make money even if the stock or option is going down. Granted, that's mostly with options. With stocks, you can buy the dip if you truly believe in the company and you've done the proper research. That way, if it is as good a company as you think it is, it will eventually go back up, which means you'll make money by lowering your cost basis per share when you buy on the dip. Now, it's a little bit more complicated with options. Sometimes you can sometimes make some money still when you have options where the stock price is dropping significantly. Other times, you just have to wait. My general rule of thumb is if it's about 10% loss and from when you got your strike price and you bought the shares, then I won't do anything. I'll simply sell calls at my strike price and just wait for the stock price to go back up and have the shares called away. Now, if the stock price goes below 10%, so between 10 and 20% loss, I will do what one of my mentors, Marcus Holcatter, says is the repair strategy. This is also well documented on the internet. Basically, it's kind of a multi-option play to where you can still usually make money and still lower your cost basis for the options. I will show a demonstration of this later in the video. And then if you have a stock that goes down more than 20% and you have enough buying power in your account, you can do a rescue strategy, which will incrementally lower your cost basis by basically selling more puts and collecting more premium at a lower price than what you originally bought them for. That way, you lower your cost basis and still collect some premium and collect some extra money. So that is the ways you can still make money in the stock market, even if your stock is going down with options. Like I said, with stocks, your options are pretty limited to waiting and buying on the dip. But that's why outside of options, I typically only invest in some dividend stocks and also in index funds like VTI and other such index funds. I also like BYM personally, but that's my personal preference. And now I'll show you how I would do those repair and rescue strategies. As you can see here, I have Riot up. I have this up because I just actually did this play last week. I sold a put at the $37 strike price and it got assigned on Friday. So Friday evening, I purchased 100 shares of Riot at $37 a share. And then this morning, it did drop today, as you can see. But I was able this morning, within about 5 minutes of the market opening, at selling a call at my strike price. So you can see here, a $37 call. And I sold that for $1.35 or $135 total. So for this one, I'm not going to do anything except wait. As you can see, I'm already at 57% profit on this. So I will end up buying this back at around 90 to 95% profit if it keeps going down, which I hope it doesn't. I hope it goes back up and eventually they get called away. But in the meantime, I'm just going to leave it as is. Now, if it goes down below the 33.30, which is 10% of my strike price, my 10% of $37 is $3.70. So that would bring it to 33.30. Right now, it's still within that 10% range. So as long as it stays above 33.30, I'm just going to wait. Now, if it drops between 10 and 20%, like I said, I can do the repair strategy, and I can't really do it right now, I can show you how it's done with the options. So this is going to be a slightly long-term play. Like, you can't do this with just every week. So for instance, let's say drop to 15%. So let's say it dropped to $30 or so. So that means I'll go to about a month and a half out. I'll check December 31st. And hypothetically, at the end of the week, my call gets bought back and it's dropped, so I can't sell another call at my strike price for any kind of reasonable premium. So as a repair strategy, let's say what I would do is see here at December 31st. And this is just, it takes some finagling. You have to test out some things. But so I would try to buy a call at the 30, which is what the current strike price would be. And then try to sell two calls at the $33 to $34 range. So basically, you would have to do a custom spread. So you would do selling 2 and buying 1 because you already have 100 shares. So that's why you would have that collateral. And by doing that, you would actually still make a lot of credit, and you would lower your cost basis at the same time. So if the stock price dropped even lower than 30, then the options expire worthless. You keep the premium. If the stock price rises above 30 but less than 33, then you can sell back this call here, and these will expire worthless, and you still make some money. And then if the stock price goes above the 33, then this will be exercised, and both of these will be exercised. So you would buy 100 shares at 30 and sell 200 shares at 33. So that would lower your cost basis down to the $33 level, and you would be out of it with a profit. Now, if your strike price drops even more and the repair strategy doesn't work anymore because it's dropped too low, then what you can try to do is a rescue. Again, this is something I picked up from my mentor, Marcus Hoketter, and he is on YouTube also, so feel free to watch his videos. I've learned quite a bit from him, and I do use his PowerX software a lot. So this isn't sponsored or anything, just so you know about a tool that I happen to use a lot and like. So the repair strategy basically is selling puts to offset and lower your cost basis. So for instance, like I said, I have shares at $37. Let's say it dropped even more to like 20 or 19. And there's no way you can do a repair strategy at that rate, and you can't do any selling of calls at your strike price because you're just not going to get any premium. So what you can do is sell puts again. So what you can do is, like for instance, sell a put here at $31. And if that gets called away, not only do you make that premium, which, by the way, in order to make this work, you do have to have enough buying power in your account to be able to sell more puts. If you don't, your only other option besides the repair strategy is to wait. Unfortunately, there is no other option other than that. But I can show you the math behind it. I'm not taking into account any premium that you receive by selling these calls and puts. Basically, the repair strategy, rescue strategy in this case. So for instance, say I bought 100 shares at $37 per share, and then I sold another put for $31 in order to try to offset that. So that's $3,700 plus $3,100 is 68, and then divided by 2 means that your new cost basis is now $3,400 or $34 a share. So that lowered your cost basis by $3, and you still made premium by doing that. And if those get called away, what you can do is, if it keeps dropping, sell another set of puts. So you can do something, say, at 25, and then lower your cost basis even more, probably by at least another $3, bring it down to $31 to $30 if that were to happen. And then you just need to, at that point, wait until if it comes back into range where you can sell calls at that cost basis. And just remember, you can take into account your premium if you want to, but that's an adjusted cost basis. I don't like doing that because that pretty much eliminates all the premium that you're receiving, and you use that instead to just lower how much you can sell for. But I like keeping the premium and instead just lowering my cost basis by determining and selling and buying shares at a lower price. So selling puts and buying them at a lower price will lower your cost basis. Buying shares on the dip will lower your cost basis. So I prefer to do it that way rather than give up the premium I make on my options. But this is completely up to you. I'm not telling you what to do. I'm just showing you how to do it if your stock price is going down. In some ways to where you can still make some money doing this, even if the stock is going down slightly, and then how to try to salvage it if it's going down a lot. Thank you for watching, and hope you enjoyed the video and found it helpful on how to still make some money with your options even if the stock is going down, and how to lower your cost basis with stocks if that's what you're doing. And don't forget to hit the like and subscribe button down below. It does greatly help out my channel. There will be links to my Discord, which is free to join, where I give daily stock picks. Sometimes there aren't any, but I will put that in the Discord also, that there aren't any stock picks for that day. Hope you have a great day. Happy holidays, since this is Thanksgiving week. And good luck in the markets.